Now let's bring in David Zervos of Jefferies, who's hoping for a more dovish Fed this week. David, do you think we're going to get one?
You know, I think, John, they're gonna spin a little dovish, or at least in the press conference, I think there's a little dovishness. The narrative that Chair Powell has pushed forward kind of hasn't played out, or the worst case scenario of what he was worried about hasn't played out. We've seen the inflation data come out better. Inflation expectations, which are probably a better leading indicator, have not really budged, even though we've had a pretty significant change in sentiment on tariffs, and even now with energy prices a little bit higher. So I think this is a very short period of time where the Fed has a window to stay in that hawkish mode, but it's closing fast.
Yeah, speaking of windows, we got those tariff windows that are still, we're going to see what's going to happen with those in just a few weeks. No incentive, it seems to me, for the Fed to act not only before that shift, but before we see what the impact is of whatever tariffs come on.
Well, I think that's right, John, but there's so many variables here. I think the administration, and this I think was a mistake on many people's part in April, the administration is actually saying that they want to try to get more cooperative trade. They want to try to open up markets. We've heard the president say that we want to open China. We want fairer, but even more balanced trade. And that's not a negative. That's a positive. That would be freer trade in many models and in many ways of thinking about this. If that's the goal, I'm not sure why there isn't some probability weight in the Fed's thinking on sort of a more positive outcome from these trade negotiations, whereby we have more openness, the U.S. is sending more products abroad, and maybe we have more investment and a sort of more balanced currency policy coming from some of our trading partners.
Do you think this Middle East conflict between Israel and Iran and the resulting energy market volatility plays into the Fed's commentary at all?
I'm sure they'll talk about it. I'm sure it will be an added risk. It's more of a growth slowing but temporary inflation story. So net, I'm not sure that it moves the policy needle short term unless something is more sustained. But I would say they're going to take quite a bit of comfort, as the market has, with the idea that, we're really only up a couple bucks in oil since these missiles started flying after a much larger rise to begin with. So the market's shrugging this off. The S&P is largely unchanged since this occurred, and bond yields haven't really moved too much. So I think they're going to be quite comforted by the market not really pricing in certainly any changes in their expectations on the outlook for equities, and even the fact that the energy markets couldn't sustain much of a rally on this is I think, very surprising to many, and certainly will be a reason for them to maybe be somewhat dismissive of the risks.
Do you think the same as usual is priced in to the markets right now, meaning the S&P, as far as the language from the Fed?
I think the market actually probably expects Jay to be a little bit more hawkish. He's been quite confrontational in speeches during the post-April 2nd period, talking much more about the risks of inflation and the risks that the tariff feedback is quite negative on the Fed's goals. That hasn't really happened. So I think the market has kind of got their sort of thinking that he's going to be a little bit confrontational. I actually think he may put a little olive branch out there. Let's see. He put an olive branch out earlier this year by nixing QT on the Treasury side. That was, I think, a sort of at least something positive for the administration to chew on. And then, of course, April 2nd hit, and we saw a very hawkish tone develop from both the chairman and I think most people on the committee. So given that nothing much has happened since April 2nd to really corroborate their views or their worries, I think maybe a little bit of a pullback is necessary on the hawkish rhetoric, and I don't think the market's necessarily prepared for that. So I'm looking for a good day on Wednesday.
Okay. And perhaps most importantly, you're not looking for a bad day because you think most of the potential bad news is already priced in?
So I would say this, John, and this is important. It's something we've been talking about with a lot of our clients. I think there was a huge de-risking post April 2nd. I think a lot of emotions were running very high. People got very nervous. We saw a very significant pullback. We saw treasuries and the dollar move in unusual correlation patterns to equities, sort of a coordinated dollar rate and equity sell-off. I think a lot of people de-risked, and I'm not sure that many re-risked. I think people will be looking for reasons to buy dips. I think people need to get back into this market, and they don't have it. I think the positioning both in the fixed income and the equity markets is light, and I think that means that pullbacks are going to be shallow in any sell-offs that we get. And I think we saw that with what happened in this recent risk-off move related to the Israel-Iran conflict. It didn't last long. That gives me quite a bit of confidence that there needs to be some re-risking as we go into the summer period.